10 years ago, the financial media wouldn't shut up about China's economy normalizing after decades of rapid growth. The debate was China, hard landing or soft landing. And after a few years, the debate seemed to die down and China was hailed as some type of global miracle economy. Of course, nerds like that guy Jim Chanos would occasionally pop up to tell us that their economy may just be built on hopes and dreams.
What we're talking about is a world-class, if not the world-class, property bubble. And by property bubble, I mean primarily high-rise buildings, offices and condos going on in China. It really is somewhat remarkable as to just how focused the investment in China is right now in property.
What a buzzkill. I mean, how bad could it actually be? It's not like China was building huge communities that nobody would live in just for the sake of economic growth, right? Okay, I get it. So after China's economy was ready to slow down after years of hypergrowth, China turned to real estate speculation to kick that economic slowdown can down the road as far as possible. But as President Joe Biden recently put it, China's economy is akin to a ticking time bomb. The consistent pattern of remarkable growth is now showing signs of strain, causing reverberations throughout the global economy and impacting investor confidence. Look, 1/3 of China's economy is said to be real estate, while 1/5 is said to be exports. And guess what? Both of these stats are crashing in real time. So guys, today we're going to dive into China's economic slowdown. We're going to explore its causes, its implications, and what the potential outcomes may be. Let's dive in. China's remarkable economic transformation over the past 45 years has seen the country go from being third world, where almost everybody was in poverty, to becoming the world's second largest economy. The country was booming up until COVID happened, and I think most people thought that they would just pick up where they left off after the lockdowns ended. Yet, the anticipated post-pandemic rebound in trade and foreign investment has failed to materialize, painting a worrisome picture for the nation's economic health. The decrease in both exports and imports by 5% and 7.6% respectively underscores the gravity of the situation. This decline not only impacts China's growth prospects, but also sends ripples throughout the global economy and its supply chains. I want to briefly take a look at some graphs from a Bloomberg article called China Sneezes, but Will the World Catch a Cold? These 4 charts give us a visual depiction of what's really happening. Now, each of these charts looks at year-over-year growth. So when these charts are at their highest, the economy's booming, and when they get below zero, that means that these statistics are contracting. First, we have industrial production, which is essentially factories, manufacturing, that sort of stuff. We can see that this has been slowing down since 2010, but really had slowed down after COVID, and I think we were all expecting a pretty big lift after the lockdown ended. It appears that industrial production may now be in contraction mode. Next, we have property investment. Now, it's not shocking to see that this is heading negative based on headlines about Evergrande and Country Garden, but it's significant because when a real estate market has been in bubble territory and it turns hard in the wrong direction, well, it tends to accelerate and get a lot worse. Next, we have retail sales, which also seem to be hitting the point of contraction, and ditto for fixed asset investments, which are also heading in that same direction. And based on these graphs, we can see how as the world grapples with inflation, China faces the opposite problem, deflation, a phenomenon where prices across the economy decline. Now you might be scratching your head and thinking, hey, lower prices sound great. But hold on, let's explain. In short, deflation means people are now paying less for stuff, which means people on the other side of the transaction are making less money, which means incomes are lower. Yet, debt levels don't shrink on a proportionate basis. In simple terms, you might be happy because you're now paying for cheaper groceries, but if you have a huge amount of debt and your income is slashed, it could be problematic to service your debt payments. So as prices decline, the real value of debt increases, making it more difficult for individuals, businesses, and the government to manage their obligations. So let's touch on China's debt. Researchers at JP Chase recently calculated that overall debt within China, including households, companies, and the government, had reached 282% of the country's annual economic output. That compares with an average of 256% in the developed economies around the world and 257% in the United States. The problem is the rate that China has grown this debt. In order for the Chinese economy to sustain itself, the debt needs to grow much faster than developed countries. And now they've basically reached their limit. Here's a clip of Michelle Caruso Cabrera talking about the problem recently on CNBC.
Their bank assets, how many loans they have? 54 trillion at the end of 2022. They have a smaller economy than the United States, and bank loans in this country are 23 trillion, roughly half. When you have that much debt, the question that China faces is how are they going to handle it? Are they going to have a full-on debt crisis? Or are they going to have a big balance sheet recession like Japan had, which means you wait for years and years for people to pay off as they extend and pretend. And when people are paying off old loans that aren't that good or are getting restructured, they don't have money to do other things like buy a car or do whatever they would do with that money. So
I mean, they're in a heap of trouble.
They're in a heap of economic trouble.
Now let's get into China and their real estate market. For decades, China's economy thrived on a growing real estate sector driven by population growth. However, the demographics have recently slowed, and the cost of real estate likely was a major part of that problem. It's said that for a population to sustain itself, the fertility rate of a country needs to be 2.1 births per female. According to the Wall Street Journal, China has had their fertility rate drop all the way to 1.09. So why is this connected to real estate? Well, when young people can't afford to move out of their parents' home to start a family, how does your population grow? Now, Xi realized this was a problem a few years ago when China introduced the 3 red lines, which was a program to slow down leverage and reduce the overall level of real estate speculation. But this crackdown has left real estate developers with massive debt and an oversupply of housing units. It's often said that there could be anywhere from 30 to 50 million empty units sitting in China, which is enough to house over 80 million people. Of course, this isn't a problem in a hot market. You can always just sell. But it's a big problem if the market's crashing. Unpaid bills from private Chinese developers are estimated at 390 billion. Prominent companies at the heart of this turmoil include Country Garden, China's largest real estate developer, who's expecting a loss of up to $7.6 billion for the first half of 2023, and Evergrande, which defaulted on $300 billion of debt in 2021 and recently filed for U.S. bankruptcy. The crisis has even impacted China's financial trust companies, such as Zhongrong International Trust, which missed payments to investors. Part of the system for real estate speculation in China involves regular people investing in financial products that are sold to them by the developers. And now suddenly we got people all over the streets in China asking for their money back. Something that is typically a risky move for protesters in a place like China. Now, let's touch on the unemployment. China's shrinking working age population is another significant factor contributing to its economic woes. The youth unemployment rate has surged, leaving a generation struggling to find opportunities. Some estimates are saying that youth unemployment in China could be closer to 50%. In response, a fascinating trend has emerged where parents are offering financial incentives to their children, encouraging them to stay at home rather than navigating the difficult job market. This movement, dubbed the full-time children phenomenon, is a reaction to the harsh realities of the notorious 996 work culture and the scarcity of employment prospects. Moreover, the curse of 35 underscores the challenges faced by older job seekers in a shifting economic landscape. When individuals reach the age of 35, they often encounter increased difficulty in finding new job opportunities or advancing in their careers. As a result, those over 35 years old may experience age-related discrimination when competing for jobs or promotions, despite their skills and experience. And at least to some extent, the global economy is tied to China's economic fate. A potential loss of confidence in China's growth could trigger a shift of investments to safer assets and perhaps slow down global economic growth as major companies shift to other countries with better demography. This could take a decade. The intricate relationships with influential partners like the United States and Russia introduce a layer of uncertainty that can impact trade dynamics and investment flows. For instance, the substantial drop of 23.7% in Chinese exports to the U.S. in June is a testament to the sway that geopolitical considerations can hold over economic outcomes. China's between a rock and a hard place right now, and it's hard to imagine an easy way out of this mess. While China's slowdown poses risks to the global economy, it could also have a positive effect for some of the Western countries like the United States. For example, manufacturing jobs could return to the U.S., reducing reliance on Chinese labor and making the U.S. economy more resilient. The strategy would likely come with accelerated automation. For example, a factory that used to require 100 workers may now only require a dozen thanks to robots doing the work. But as for Xi and China, we have this president who said to surround himself around yes men and people who are afraid to speak up. Now, this is scary because of the situation in Taiwan, which could turn into an invasion to distract the people of China from the current narrative or economic disaster, if we want to be frank. This is a scary thought, and I have to say, when you look at guys like Kyle Bass and Ray Dalio, who are both experts on China and generally don't like each other, they're both saying that China invading Taiwan is the most likely outcome. And we got to accept that this is a real possibility and just hope that it doesn't come to fruition. All right, everybody, thank you for watching. If you could do me a big favor, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Do you think that China is going to be fine? Do you think that the narrative is just swaying too far with the financial media and there's a bit of a groupthink going on? What impact do you think the slowdown in China could have on the global economy? Are you invested in Chinese stocks? What are your thoughts, guys? Let me know what you think in the comment section. All right, I love you all. So guys, we just recently launched this channel and we noticed that 99.9% of our viewers are not subscribed. So if you enjoyed this video, we need your help in growing this channel. By subscribing, that would help us keep the lights on and make sure that our crews have jobs in these uncertain times. So please hit that subscribe button and we promise to make more quality videos that I'm sure you're going to love.